Welcome to the Lockshield Partners Podcast. We believe in financial literacy and love to provide quality information when it comes to areas around financial planning and how it impacts your life. To learn more about what we do and how we serve our clients, visit us at lockshieldpartners.com.
Dan, welcome back. We've got another edition of our Lockshield Partners podcast today. And today we're talking about a concept that I really enjoy. I think we both appreciate the Qualified Charitable Distribution, QCD.
Yeah, it's meaningful.
It's always really encouraging to see folks who really want to use those resources that they've accumulated to make a positive impact on others. And we know just from an internal standpoint, we want to be good stewards of these resources.
Yeah, we love that word, stewardship. And that's what this is about.
It is. So Qualified Charitable Distribution.
Yep.
We've maybe just kind of scratched the surface before on previous editions.
Right.
When we've talked about required minimum distributions, but let's maybe just start with the basics. What Qualified Charitable Distribution, what is that?
Yep. So let's just break it down. Alphabet soup. The IRS is very good at that. Qualified meaning the IRS is okay with it.
They put their stamp of approval.
They put their stamp of approval. Charitable means it's going to a charity, a church, a nonprofit, not your kids, not the church's auction where you get a trip to Destin or whatever. So it has to be a true charitable.
Okay.
And deduction means I get to deduct it. And that money is sent from your IRA, normally directly to you, the client, and then you deliver it.
Let's touch on that real quick, Dan. I do think there's an important distinction. In order for it to truly be treated as a QCD, though, even though the check may come to you, it can't be made out to you.
That's exactly right. So it needs to be made payable to the charity or the church. So where it would work for our clients is I'm in RMD or I'm 70 and a half.
You can start a little earlier.
You can start earlier because that used to be the RMD age. Now it's 73. So the whole idea is I'm at least 70 and a half and I make charitable contributions and I have a traditional IRA. So the IRS says, because the IRS likes to promote charitable giving.
They do. So
it used to be where we might itemize our charitable contributions. If our charities and church and mortgage interests exceed the standard deduction, then you itemize it. Well, this works out great because you can still take the standard deduction,
which is about $30,000 for a married couple.
$30,000. So if I'm going to give $5,000 to the church, that's great from a charitable point of view, but from a tax point of view, there's no benefit to the taxpayer, to you, the client.
On your federal return.
On your federal return.
Your state return, it may matter.
It may matter, right. But I can also do it directly from my IRA, my traditional IRA. Roth does not have a required distribution. So Roths are separate. So I decide this year I'm going to give X amount. I'm going to come and sit down with Clark Hayden and say, Clark, I'm going to give $2,000 to this, $2,000 here, $3,000 here. You fill out a form, and then 3 checks or however many checks are sent to you for you to deliver.
So there's no limit on how many organizations you do this for. They don't say you can do this once a year, nothing like that.
Right. The only limitation is there's a dollar limit. It's fairly generous, $105,000.
Okay.
Per taxpayer.
So that's a significant number.
That's a significant number for most people.
That's not probably coming into play.
That's probably not coming into play. From a practical point of view, what Jody from our office would probably say is, look, if you want to give $50 to whatever, just write the check.
Let's maybe not go through with the process of doing this.
Right. But if you're going to give $500, whatever it might be, certainly $2,000, $5,000, $10,000, $30,000, then let's use a QCD. That money is not taxable to you, and you still get to take the standard deduction, which is significant. And from a big picture tax planning point of view, and these things are always best done in collaboration with your tax preparer, because there's always quirky rules, and your financial planner. But
Absolutely.
The more your taxable income is, that's taxable, but it may start to pull your Social Security to be taxable as well.
There's a waterfall effect.
There's a waterfall.
Retirement.
And if this is an efficiency that we're given, a planning efficiency we're given to use, then we need to use it.
Let's take advantage.
Let's take advantage of it.
Yeah. So let's real quick on the tax stuff, Dan. Let's maybe touch on that. So just to hit those high points once again, if we're utilizing the qualified charitable distribution, we're lowering the amount that's in our IRA.
Correct.
Which means that the required distribution we have to take in the future is less.
Correct.
So it, in some ways, has a tax impact in multiple years.
That's right.
Quite frankly.
Right.
If we're using those qualified charitable distributions, it also means our beneficiaries would inherit less in taxable IRA assets and more in something like cash,
and
which is much friendlier to your beneficiary.
That's right.
And then, as you mentioned, if we're not counting that money as income, then we pay less on our Social Security or our pension or whatever our other assets are. So really, it's not that we're just saving the 10% or the 12%. It could be significantly more than that, depending on your situation.
That's exactly right. And from a cash flow point of view, a lot of people may be giving $500, $700, whatever it is, every month, every couple of weeks to the church. Well, if you're required to take money out of your pre-tax account anyways, if you can use that as your charitable contributions, that will preserve the money that's in your checking account. So from a cash flow point of view, I think what we hear from clients is it makes a difference. There's some tax savings, and maybe they're aware of the 10%, maybe not. But from a cash flow point of view, if you are 70 and a half and you have a traditional IRA and you make charitable contributions, you should take a really good look at doing QCDs.
It may not make a crazy difference, but it's an efficiency.
Sure.
Something else I would add on that, Dan, while we're talking about it is, when we get into retirement and at any point, but especially in retirement, we want to eliminate unnecessary expenses, unnecessary liabilities. This is a really easy one.
This is a no-brainer.
It's a no-brainer. There are other instances, and I'm going to take a quick aside from QCDs for just a second, but it's the same concept. For folks who may not be quite at retirement age and they have non-retirement assets, or even people maybe who are in retirement, this could still apply.
Sure.
But for folks who have non-retirement assets that have increased in value, for example, if somebody bought stock A for $10,000 and that stock is now worth $20,000, instead of writing a check to their church or charity of choice, they can choose to gift those appreciated shares.
Right.
The reason that they would want to do it, it's just like our QCD. They can gift those shares, meaning they don't have to sell it. If they sell it, they have to pay tax on the gain. When the charitable institution receives those shares, they can sell it without paying any tax.
Right.
So nobody ever pays tax on that appreciated asset. Just like in the QCD, I like to explain it and think of it in the sense that no one ever paid tax on that money.
Yeah.
You didn't pay tax on it when you received the income. You didn't pay tax on the earnings. Then the charity didn't pay tax when they used that resource for whatever.
And the IRS is okay with that. It's a qualified. So in our case, the qualified charitable or with gifting shares, the IRS is okay with that.
Right.
Fine.
Most people like the concept of that money never being taxed.
Sure. Absolutely. So one thing with whether you're gifting shares or you're gifting money from your IRA versus your checking account, sometimes it can feel different. When you write a check or you hand over cash or you put money in the basket, a check, it can feel different. The money is still good to the church or the charity.
They probably don't care where it comes from.
They don't care where it comes from, but it can feel different. And that's an important emotional and psychological part of being a steward of your resources.
One thing, Dan, I would also mention from maybe the receiving institution's standpoint, especially if it's maybe a smaller or a newer charitable organization or church, it's definitely a good idea to give them a heads up.
Definitely. Sure.
They may not fully understand what it means to receive a qualified charitable distribution or what it means to get a stock gift or what to do with that. So before you go through with it, before you have your financial planner get that distribution processed, definitely make sure that the institution that the money is going to is is in a position to receive those assets.
Yep. In our experience, for those smaller organizations or smaller churches, if there's a member of that congregation who wants to make a contribution in that way, the church is usually very open to setting up an account to receive
Absolutely.
those.
And it's
That's easy
a
to do.
pretty straightforward process on their behalf. So just a quick note on that.
Yep.
One other thing, Dan, I'd like to mention on especially with the qualified charitable distribution, this would also apply to the gifting of shares, but it's really important to keep track of that because we've touched on this before. Anytime money comes out of an IRA or out of a retirement account, that automatically triggers a 1099-R.
The IRS wants to know about it.
The IRS wants to know about it. However, if that money is given via qualified charitable distribution, it doesn't say that on the 1099-R.
That's a big one. And thank you for bringing that up, because it's not the custodian's job to determine who's a qualified charity.
They don't want the liability to determine that.
No, they're not going to police that. So if you take out $10,000 from your LPL IRA, your Charles Schwab IRA, they're going to say you took out 10 grand. Your job is to tell your tax preparer, you can bring the check stubs, or hopefully the charity sends you a statement, hopefully with a handwritten thank you note, potentially. So then you can show, here are the charities I gave those.
Here's
to.
the proof.
And a really good tax preparer, I had a CPA one time call me because he said, I don't know these checks went there. So he actually requested the return checks with the church's endorsement on them. It's like, well, now that's a
an
true
extra
account
step
right there.
That's an extra step. Yeah.
So to kind of, one other quirky thing, QCDs are only from IRAs, not a 401k, not a 403b, an individual retirement account. So let's kind of bring this one in for Landon Clark. Who is the ideal candidate to make a qualified charitable distribution?
Sure. High points would be somebody who already makes charitable contributions or is interested in doing so. They have IRA money. They have traditional IRA assets, pre-tax assets, and they're over the age of 70 and a half. Those are kind of the three qualifications. And I would say, even if it's just $1,000, $2,000, it doesn't have to be a crazy amount of money that someone is looking at gifting.
Right.
That's plenty to take advantage of a QCD.
Sure. And an interesting concept, because someone might say, well, I'm only saving $100. Well, how about this? Instead of giving $1,000 to the church, you do a QCD and you give them $1,100.
There you go.
You give the church
You've
tax
maximized
savings.
your impact.
That's $100. That's rather than going to the IRS, and nothing against the IRS, but we would probably rather you direct the impact of your resources.
It's nice to see that money go right back into your community.
Absolutely. And these are planning things that are there to take advantage of. So if somebody finds themselves in that category that you just so well laid out, you need to be asking about a qualified charitable distribution.
Thank you for joining us today. If you have more questions on qualified charitable distributions or RMDs or gifting shares of your non-retirement assets, make sure to check out our website at lockshieldpartners.com.